Hello, everyone. This is Stephen Richardson. Today, we're going to be talking about the Stock Selection Guide Basics for Beginners, Quality Check. You can find all of my stock investing videos, basics and advanced, on YouTube, just like you found this one. So, when you go to look at a stock, you don't just hear a hot tip from someone, oh, I'm going to buy it. You want to research this stock thoroughly, and there's two steps. There's the quality check, and then there's judgment, your judgment, whether to move on or not. So we're going to be looking at the quality check and how you can use that to filter out stocks, whether they be good or bad stocks. Today, I'm not giving any financial advice. I never give financial advice. This is just education purposes, these videos, just to educate you. Okay, what is a stock selection guide? Stock Selection Guide is a product that's published by betterinvesting.org. I highly recommend that you don't walk over there and subscribe to this. Very powerful tool. What's Better Investing does, they've been around for 70 years now, 70 something years. And they take all the data from the annual reports and the quarterly reports, and they put it into one convenient location so you can see for the past 10 years what a stock has done, their trends. You can see their price earnings ratio at the valuation return tab, dividends, all conveniently at your fingertips rather than going through annual returns and trying to find this and using an Excel spreadsheet to tally it all up. It's right here. It's lovely. And so that's what we're going to be talking about. All right. So the first check is looking at the fundamental company data. And you can see there's three lines here, green, pink, and blue. For now, we're looking at the green and the blue. That's sales and earnings per share, respectively. You want the green and the blue line to be up. You don't want it to be flat. Flat means no growth. Down means losing growth, decreasing in growth. So up means increasing. And you want that increase to be steady at a consistent rate, which means straight. You can have some undulations here and there, but you do not want roller coasters, huge, big roller coasters, which oftentimes you find that in the earnings per share and the pre-tax profit, where if the sales are steady, they might be losing some money somehow. So you want that to be straight. And then you want them sales and earnings per share growing at about the same rate so that these lines are parallel. Up to the right, straight and parallel. Up, straight, and parallel. That's how you want it. That's how you want to see it. Does this company have sufficient growth? Small companies, which earn less than $1 billion in sales revenue, should be growing at a rate of 12% or greater. Normally, it's much greater because they're a breakout company, limited expenses, and make a lot of money. And then the medium size companies that are greater than $1 billion, less than $10 billion, should be earning 7 to 12% for their growth. And more than 12% is better. More is always better. The large companies greater than 10 billion should be earning 5 to 7% or greater. And you can see that this company is 116 billion in revenue last year, or 2022. So this is a mega large. It's in the large category, and its growth rate the last 10 years, 36.2%. It shatters the 5 to 7%. It's a pretty good company, growth company. And you see the angle of those lines. It looks like it's about a 30-degree angle. The sharper the angle, the more the more growth year over year. The sharper that angle. You don't want it flat. That, like I said, if it's flat, it's not increasing. Flat's better than down, but it's still not increasing. You want to check the recent quarterly growth. Is it in line with the historic growth? So the quarterly growth, that's the most recent quarter compared to a year ago quarter. The sales were 23.2%, and the 10-year growth was 36.2%. So that's in line. It's close. So they're steady. Earnings per share for this past quarter for this company, 167.7%. That's phenomenal compared to the 38.8% over a 10-year period. And you can see that hook kind of dips up on the quarterly where they're open circles. The solid circles are annual reports, and you can see that sharp increase. It's probably from the COVID. There's decrease and a sharp increase. And by the way, those vertical lines there that you see, that's the high and low stock price for that year. High being at the top, low being at the bottom. And then the little red triangle things, that's where the stock price is right now as of when this was snipped. Very great. If you hover over them, it'll tell you the amounts. So it's really powerful tool. All right. The next thing you want to look at is pre-tax profit on sales. That's the margin. Historical profit margin should be steady, even, or increasing. Here, the trend is downward. They started out with 50% margin 2017. That is phenomenal for any company. I don't care who you are. And it started to dip down a little bit. And it's a big company, so it's understandable. And the 5-year average is 36.8%. Profit should be as good as or better than competitors' profit margins. And you can click on that compare peers button, and several peers, 3 or 4, will pop up. The industry average will pop up, and you can see how the pre-tax profit rates among competitors. All right, return on investment. Historical return on investment should be steady, even, or slightly increasing, just like pre-tax profit. If there are significant changes up or down, they should be investigated. Go into the annual report or the quarterly report to find out what happened to the return on investment. Look for companies with at least 15% return on investment or greater. Great companies achieve return on investment of 20% or more. And you're seeing I snipped this evaluate management return on equity. That is on the slide or on the screen for you to see. I just snipped it so you can see it in this presentation. A lot of data, a lot of great data. Okay, debt. Next thing to look at is debt. In general, you look for debt levels to be less than 33% of capitalization. You compare to others in the industry and consider the industry averages. You compare peers and see this company, 5-year average 9%, and it's an upward trend, the debt. Debt is not bad. You need debt for capitalization or other reasons, established credit. But there are exceptions to the 33%. Real estate investment trusts, they generally have debt that's greater than 80%. They purchase properties, large properties, for hundreds of millions of dollars, and then they lease that out to tenants. The tenant would normally put their name on the building and sublet floors. So they get revenue from the rent. And so they have all these properties. So usually real estate investment trusts have the best dividends because they give out almost their entire profit as dividends. Same as for like airlines, but Delta and United, Alaska, Southwest, they could buy 50 aircraft, but it's so expensive. All their money would be tied up in these aircraft. So there's a middleman, Air Lease, who purchases the Boeings and the Airbuses and leases them out to the major renters, United, Alaska, Delta, for a period of time, 5, 10, 20 years, just like real estate investment trusts. And the concept is the same. So if all of these pass your quality check, up, straight, parallel, debt less than 33%, return on investment less than or greater than 15%, then it's time to move on to the next stage, which would be your judgment to move forward and look at this. If these things don't pass, the up, straight, and parallel doesn't pass that, don't go any further. Don't waste your time. Thanks, and I'll see you on the next video. If you liked what you saw, click subscribe.